I'm speaking to you from Singapore on Wednesday afternoon. Later today, when Wall Street opens, we're going to get the release of two pieces of economic data. U.S. GDP data for the first quarter, what rate of growth the U.S. economy grew at during the first quarter, and PCE data, personal consumption expenditure, which is included in that is the Fed's preferred measure of inflation, the PCE core price index. Now, what the market doesn't want to hear from those two pieces of data or doesn't want to see are signs of stagflation. Those are always bad for the market. And the market's probably a little bit vulnerable right now to bad news because we've just had a 10% upswing in equity prices from the beginning of April. If you remember, shortly after Trump announced his tariff plans, at one point the S&P 500 was down 19% from its all-time high. It was knocking on the door of bear market territory. And today we're about 10% higher than we were at that time. So a lot of people who kind of bought on that bear market news, they probably feel pretty good about it, and they probably are thinking, well, maybe I should take some profit if we have some signs of bad news that could drag the market right down again. So let's take a look at those two pieces of data. Usually Wall Street economists have a pretty good idea how quickly the U.S. economy was growing. They don't get it perfect, but they're at least usually in the ballpark. This time, estimates are just all over the place. You have some of them predicting economic growth could be as bad as negative 1.7% in the first quarter, and you have other ones of them predicting positive growth. You put it all together, the average is for 0.8% growth. When you have such a wide dispersion of estimates, I'm not sure how important the average is. But anyhow, that's if the market's worried about stagflation, the market will be happier to see if economic growth is positive. It doesn't mean that if it goes negative that necessarily that the markets are going to sell off, because very often, if you have negative growth, the Fed can react to it by cutting interest rates, and that usually boosts the economy. And of course, lower interest rates tends to boost the stock market as well. So it doesn't necessarily a bad thing that if the economic growth is lower, but people will be concerned because you got to remember, if we had negative economic growth in the first quarter, that was before Trump rolled out his April 2nd tariff announcement, which has had some impact on consumers and consumer confidence, and which would obviously have some impact on the U.S. economy. So basically, we're getting the pre-bad tariff news in that fourth quarter. If the U.S. economy is already at a negative growth rate, then people will be thinking, wow, in the second quarter, it's got to even be worse. So that's the first bad shoe to drop if we have a negative growth rate. And the second bad shoe to drop would be if the inflation data isn't as good as expected. And this one's a little bit spooky because the economists are expecting that number to be good. This will be a number from March, so it's a little bit stale. I would expect that we're almost already in May, but February's data was like a 2.8% year-on-year core PCE growth rate, and it's supposed to decline to 2.6%. And 2.6% shouldn't sound too bad to you because the Fed is target is only 2%. So it means they're getting pretty close to the target, and you don't necessarily have to measure things year on year. If you look at 6 months, maybe inflation rate is already down to the Fed's target, which would mean that the Fed, if the GDP is really weakening, the Fed would feel that they had the opportunity to cut interest rates. If inflation number is bad, and that's why I said it's kind of a shame that the market's expecting a good number. If the inflation number is, because it's harder to hit a good number, but if the inflation number is bad, then the assumption is the Fed would want to wait to cut rates. So you'll be dealing with a slowing economy. You would still have interest rates where they are now, 4.25% to 4.5%. And that probably would send, the combination of those two would send the stock market lower. So do I really think that's going to happen? No, I'm sort of an optimistic type. I have a hard time believing that the US economy just hit the brakes like that. I mean, not that it's impossible, but you got to remember, fourth quarter GDP, the US economy was growing at like a 2.4%. For it to suddenly go negative doesn't really sound too possible. So I think we'll get a positive number there that'll keep us a little bit calm on the stagflation rate. And I think, let's just hope the economists are right and we get that 2.6% number, because if we get that, it's a good direction. And then, of course, the assumption would be, with the slower economy growing slower right now, that inflation would drop further. So I think the two numbers coming out represent a risk, but I think we'll probably get through it tomorrow.